Morning to our wonderful audience and a great big warm welcome to Boutiques on Wednesdays again. Always lovely to see so many of you on the call today. Emerging market equities are having a standout here on the back of a weaker US dollar. And with the AI revolution, there are new tailwinds for select emerging market tech companies. But can fund managers extrapolate some of these opportunities to benefit your clients? Some argue that US exceptionalism is declining, but what does the outlook of the US economy have to do with SA fixed income markets? We have a fantastic session planned for you this morning to unpack this and so much more. And to do so, it is my great pleasure to welcome Kagiso Selelo, equity analyst at All Weather Capital. She'll be focusing on the global markets and emerging markets and those tech opportunities. And then we've got Jurgens Skuman from ID Capital to look at SA fixed income and exactly that. What does the US economic outlook have to do with SA fixed income? Good morning, Jurgens. Good morning, Kagiso. Thank you so much for joining us this morning and your time. I had a brief look at your presentations and it really looks very interesting indeed. And again, it's with great pleasure that we have you on our session today. Kagiso, I see your presentation already up and running. Thank you so much. We are ready for you if you are.
Okay, thank you, Eugene. Thank you for having me, and thank you for the audience for joining us online. I think before I start with the presentation, I'd like to say that we've had the opportunity to engage with BCI as well as BCI clients several times over the years. And so a lot of you guys on the call right now are quite familiar with the All Weather brand as well as the All Weather firm. But most of those interactions have been from a South African perspective, from our South African local team. So today I will be speaking as part of the Global Emerging Markets team, which is the global offering, offshore offering part of All Weather Capital. So we only have about 15 minutes, so I'm going to keep the agenda very focused. So first of all, I'm going to do a quick business overview of our structure as well as our strategy of All Weather Capital, the GEM Fund. And then I'm going to dive into how emerging markets are driving the AI economy and where we see the most compelling opportunities. So firstly, on the All Weather Capital GEM Fund structure. So currently, we are a dollar-dominated UCITS fund that is domiciled in Ireland. However, we will be launching in early 2026 a BCI ZA feeder fund. And that's just going to make our strategy a bit more accessible to the local SA investors. So when we talk about performance across the different market regime, I think for us, it really comes down to two things. So that's stock selection as well as risk-aware EM agility. So our process was developed by an emerging market team for emerging market. So we really combine a very deep fundamental research work with a geopolitical lens. So at a very high level, the framework really focuses on being dynamic, quality-driven, valuation sensitivity, and importantly, applying the EM-specific risk overlay just to size and adjust exposures as those conditions change. And obviously the outcome of that is a diversified style agnostic portfolio of around 55 to 75 stocks that are really designed to hold up and perform across those different market regimes. So I think in summary, our process is quite a disciplined and balanced process that blends both fundamental depth as well as with true EM agility. So this is our team that really makes it happen. So we are built for emerging markets. We are native to emerging markets, and our process is really shaped by a disciplined, research driven investment approach. And we bring quite deep EM experience with decades of research expertise. And I think if you also look at this slide, you can see that it reflects diversity of background, diversity of age, as well as diversity of perspective. And we think this is quite a crucial element in being able to understand the EM complexity and EM role. Over and above that, we are supported by our South African investment team, which is a team of 14 investment professionals that help us cover around 15% of our benchmark. So we thought it would be quite engaging and relevant to include a short section on AI. And not just because it's topical, but we of the view that it's really reshaping global markets in real time. And we think what's often overlooked is how many of these hidden AI ecosystem winners sit within EM. So I'll just walk you through what we see in terms of innovation, competitive advantage, as well as long-term opportunity within EM in the AI ecospace. So AI is really shaping the global economy, and it's creating a new wave of demand. So this is demand for compute, demand for data, and demand for energy as well. So we think that this isn't just another technological trend, it's the next industrial revolution. So it's constantly and rapidly changing how companies invest, how companies compete, and how companies produce. So if we look back, right, into every major tech wave, from the internet to mobile to cloud, they have always expanded the global addressable market. And we think AI is also doing the same thing, but at a much faster and deeper rate. So on the demand side, so this is the chart by Avio Capital Markets. They projected that by 2030, the total addressable market from AI would reach around $1 trillion. And that is a conservative view compared to the broader sell-side consensus, which have a target of around $2 trillion US. So we're just saying that either way, we're still in the very beginning stages of the AI build out. And I think what's important here is that the CapEx is really supporting the growth, and the largest beneficiaries of those CapEx sit in the hardware and also in the infrastructure layer of the supply chain, like your semiconductor, your memory players, as well as your energy players. And that is where emerging markets plays a critical role. So the AI momentum that we've been seeing quite lately has been quite extraordinary, right? The adoption rates across these platforms are unlike anything else that we've seen in the prior tech cycles. So if you take OpenAI, for instance, so that is ChatGPT, its users grew 100 million users in just 2 months. So that is one of the fastest growing consumer technology platforms in history. It's outpacing the likes of TikTok and the likes of Instagram. And if you look at Gemini, which is the Google AI ecosystem, its monthly active users rose 45% quarter on quarter, from 440 million to around 650 million. And if you break it down a bit more further into more detail, the tokenization on a monthly basis, this has risen to around 1,000 quadrillion, having a Zimmer moment. So this is like a threefold increase in just 6 months. And I think just for a bit of context, so in artificial intelligence, right? Tokenization is really the process of breaking down the data. Your data can be like your raw language that you speak, it can be your audio, or it can be your image into standardized units that are called tokens. So AI models can't directly interpret your raw language. They interpret these things called units that and also called tokens, right? So hence we think that these sorry, move to the next slide. So hence we think that these monthly token volumes are really a very strong indication and a practical proxy for adoption and engagement of AI. So it's reflecting the number of queries, it's reflecting the number of interactions and the workloads that AI can handle reliably. And the infrastructure that is supporting that, especially in the semiconductor supply chain, is still catching up. So it's really highlighting the ongoing growth opportunities in the space. So we've seen quite insatiable capex, right? So across Microsoft, across Google, across Meta, across Amazon, management continue to report capex levels that are running ahead of plans, and also sometimes revising these capex levels upwards. And this is because of the expected demand. And the commentary has been consistent. AI workloads are still capacity constraints. So they require investment in GPUs, they require investment in your HBMs, which are your high bandwidth chips. They require power and they require advanced packaging. And this demand is not only coming from consumer-facing AI, but also companies have highlighted that they're seeing a lot of demand in enterprise AI. And also, in addition to consumer and enterprise AI, we're seeing interest from governments whereby they want to build their sovereign AI data centers. So countries are also beginning to build their own national AI capacity. So as a result, these major platforms have said that their capex outlook for the next few years are going to remain elevated. And obviously it's driven simultaneously by that demand in consumer AI, in enterprise, as well as these sovereign AI build-outs. So a significant portion of the world's AI infrastructure is physically produced in emerging markets. So most leading edge fabricators are situated in Taiwan and South Korea, and also the back end, the assembly and testing guys are situated in China and also Malaysia and a bit of Vietnam. So and also beyond that, beyond manufacturing, EM also supplies the talent that does the research. So India supplies your engineers as well as your researchers. And also people of Chinese origin currently remains one of the largest AI research hubs globally. And we think that as hyperscalers deploy their AI infrastructure, how critical EM is in this is becoming more and more visible. And we think that their capex really points to a sustained demand, especially on the advanced logic chips, on the memory chips, in energy. And all of this is directly drawn from the emerging market supply chain. So even with this strategic role, right, in AI infrastructure, many of these EM technology companies continue to trade at a material valuation discount to the US peers. despite delivering similar or stronger EPS growth. So the market attention remains heavily concentrated in the US. It heavily is concentrated on the Mag 7, right? So which means that several of these EM names are still priced as if they are cyclical rather than the beneficiaries of this long duration AI build out. And we think that's what's often overlooked is the depth of the technological capabilities of companies in the emerging market space. So we thought it would be quickly useful to show how we're capturing this AI infrastructure opportunities through our stock selection. So I have a quick example on TSMC, Taiwan Semiconductor Company. So TSMC is really the largest advanced semiconductor manufacturing company in the world. So they produce these high-performing, high-compute chips for the likes of your NVIDIA, Apple, and AMD. So it manufactures over 90% of the world's leading-edge chips. So for people less familiar with the supply chain in the call, TSMC is pretty much simply the company that turns your AI chip design into a physical silicon. And so as these AI models scale and compute requirements go higher and higher, TSMC has become quite central to that node in terms of supplying these advanced processors for accelerators and GPU. So AI now has become quite a meaningful driver of both revenue and capex. And the company is reporting all-time high revenues and margins, supported obviously by the strong high computing demand as well as AI. But what we particularly like about TSMC is management commentary around its disciplined control, capex, and margin protection. However, they're doing targeted investment into next generation technology. So the recent results show really record high revenue and historically high margins. So obviously this is supported by the mix and shift towards your AI and high computing chips. So this chart really shows that revenue growth has been accompanied by stable and improving margins. So it just reflects how strong the demand are and how effective the pricing is at these valuation nodes. And on a valuation basis, the forward PE remains reasonable, given that TSMC is has a moat, has a technological leadership, record profitability and margins currently, and strong visibility from these AI-related orders. Their capacity is full until early Q1 2027. And last, I'll just quickly run through SK Hynix. So SK Hynix is one of the largest memory manufacturers, and we think it sits directly on the bottleneck of AI, which currently is the memory bandwidth. So the company has built a leadership in the space with this HBM chips, which are very essential in training and running these large AI models. So currently it is the biggest supplier of HBM to NVIDIA. And notably, it's the only company now that has been qualified for NVIDIA to supply the HBM4, which is the chip for NVIDIA's next gen chip. And management has made comments that they see the HBM demand growing more than 100% year on year into 2026, 2027. And these are really also coming from really high base that we've seen in 2025. So the company is showing strong visibility, and we think that major clients have already secured a large share of next year's production. And also, I think it's also worthy to note that over and above the structural AI growth, we're seeing that the conventional memory is also entering into an upcycle. So you have that cyclical support as well as the structural long-term AI support. So the current free cash flow is around 10 to 11%. So that is towards the upper range. So it just shows that even with these elevated CapEx to support the continued AI demand, it continues to generate strong and improving cash flows. And this is obviously supported by the better pricing, the mix, and the rising utilization rates. And historically, when free cash flows have been at these levels, it have coincided with a re-rating. So we think that as SK Hynix is now the sole supplier of HBM4, NVIDIA's next generation chip, the forward demand is a bit more clearer than in the past cycles, but yet the valuation compares if this is a typical memory cycle. And I think this suggests more room for a multiple expansion. I think because of time, I'll just end it here. The rose gold bars are the all-weather capital gem fund, and the dark green bars are the MSCI EM benchmark. So we're just showing that across every period, the fund has consistently outperformed. We're very happy with performance. So I'll just close by saying that we're pleased with the consistency of our performance and believe that the fund is well positioned for the environment ahead. Thank you, Jean, and back to you.
These are very interesting indeed. Thank you so much for that. We're going to pause there. To our audience, you know how it works. You can post questions. I can see some questions coming in. But before we take those questions, I'm going to give Jurgens an opportunity to share his slides.
Morning, Eugene. Thanks a lot.
Fantastic. I can see your slides coming through. Yes, got it.
All right.
And full screen, perfect. Yes. Jurgens, thank you so
You're
much.
on full screen. Okay,
Yeah,
no worries. All good.
perfect. Thank you.
Eugene, thanks again for having us on these BCI Boutique Wednesdays. It's our second run. So my name is Jurgens Kuman. I'm from ID Capital. We're a small boutique asset manager based in Cape Town, and we've chosen cars as our theme for today. Before we dig into our theme, let's set the scene. So today we'll be discussing the ID Capital BCI Income Fund, and we use a building block approach to portfolio construction. And as you can see from here, we use fixed income asset classes to both the left and the right of where our actual portfolio plots on the efficient frontier. On the credit side, we use funds to express our views, and but today's focal point of this discussion is fixed rate bonds or govies, and that part of the portfolio we manage ourselves. Just a quick roadmap of how this presentation is laid out. We'll start with the world economy and then bring it back home to South Africa, and then ultimately to our fund positioning and its performance. Just to reiterate, we've chosen cars as the theme, but why have we done that? So it allows us to look underneath the hood of the world economy. Manufacturing's contribution to GDP is all the rage in the Trump's tariff, and also on the other side as a sentiment indicator. So from the consumer side. So when your finances improve, you can buy new cars, and that's often taken as a leading indicator of economic recovery. But then also on the other side of that, it's on the consumer end, it's a credit indicator. So when things get tight in the economy, there's a bit of credit stress that build up. So just World Economy 101. So this gives you a great snapshot and overview of the world economy pre-Trump. So you can see there's the US economy, 60 to 70% of GDP is consumption driven. And then on the right hand side, gross fixed capital formation, very high gross fixed capital formation from the Chinese side. And that's to build factory capacity. In other words, China being the factory of the world. And then on the left, the US consuming all of what's built in that factory. But the challenge now is how the US will continue to consume these products at scale. Flipping across straight to monetary policy on the Fed side. So just a reminder, the Fed's got a dual mandate of maximum employment and low inflation. And this graph on the left shows you how that Fed dilemma is playing out with a fork in the road with very high inflation, or inflation trending higher and higher, and jobs growth being under pressure. On the right hand side, you can see then that what these tariffs will do to the US from a manufacturing perspective. So the average car price in the States is about $50,000. And then you can see, let's just flick back one, doesn't matter. So if you can see on the right hand side, the cost of imported vehicles and the impact of that, if it's US built, around 2%. Let me just flick across to the next one. Mexico and Canada, 10%. And then on the last one, if you fully imported, it's about 11%. So you can see the pressure from and how we play this car theme into showing you the inflationary impact and how that could still be an issue to the Fed in deciding to cut rates or not. Then from the consumer side, so that's on the manufacturing side. On the consumer side, if we look at unemployment and the effects of that, before we dig into unemployment, let's just look on the left. So that's there's some although credit markets, the spreads are very tight. In the auto industry, there's a bit of trouble brewing under the hood. So we've seen the first brands bankruptcy, but then also the Tricolor Auto bankruptcy. And then on the unemployment side, so more recently, the Challenger Grain Christmas report has shown there's been job losses to the effect of 1 million people losing their jobs over 2025. And 2025 year to date, this is the 5th highest in the 36-year history that these guys have brought out this report. And then you can see this this issue on the right hand side of jobless growth. So it talks to the distress on lower income borrowers and consumers, and you can see this in the delinquency of the subprime sector rising. So subprime being smaller portion of the market, then more sensitive to deteriorating consumer environment. And then we have to show you this one. So this is going to be quick, but this is Mr. Trump bringing down the house. So when a picture is worth 1,000 words, you can see this is the construction then tearing down the east wing to build the banquet hall. And incidentally, this digger loader he's using to tear down the house, not made in the US. So Trump economics and the policies of him in all of what he's doing is underpinning and weakening the underpin of dollar dominance. So, and driving down then ultimately US exceptionalism. Digging into the second part of our presentation, the middle part. We do an economic huddle just to recap what we just said. So what does all of this mean for South Africa and in terms of portfolio positioning? Because in China, we've got excess capacity and deflationary aspects coming through. US, we've got a weaker dollar, and South Africa is ultimately a beneficiary of both of these trends. But as the equity guys would tell you, there's a self-help story, and from a self-help story and a perspective, how does monetary and fiscal policy support additional upside for fixed rate bonds in our context? This is very high nominal and real rates. You can see we don't have inflation here, but these are very high nominal rates. If you put this in perspective, there's the inflation differential between the States and South Africa is almost the same. So both are around 3%. So you can see here the attractiveness of carry of investing in South African bonds. Yes, we are in a cutting cycle, and there's differing opinions of how far and how fast we can cut rates. Forward rate agreements pricing in 2 and a bit worth of cuts. We've seen the SARB in its quarterly projection model around 4 cuts. In other words, taking the nominal rate down to 6%. But then recently we've seen the Bureau of Economic Research come out to say it could be cutting, they expect SARB to cut rates to 6, 7, no, by 5 quarter points. So actually taking us below 6%. So that all creates some positive momentum for us for fixed rate bonds. But it's not all that well in the South African economy. We're coming from a very low base. You can see our GDP growth over 5-year periods. And currently this year expected to do 0.8% GDP growth. However, this could double next year to 1.6%. And that's why, and the reason you will see further rate cuts. But to bring this back to our car theme, manufacturing is purring along. This is on the right-hand side, around $10 to $12 billion per annum for South Africa. So the blue on the bottom is the United States contribution, where we predominantly export Ford Rangers. So you can see that dip on the far right bottom blue. So it's slow and steady, but it won't, manufacturing itself wouldn't be a catalyst for growth, economic growth in South Africa. Although South Africa is the most industrialized economy in Africa, we aren't actually a manufacturing economy. It's more consumer driven. So on the flip side, we see sentiment loading with big uptake in new passenger vehicle sales in South Africa. So you can see there, South Africa car sales surged to 11-year high on cheaper imports. And those cheaper imports are coming from China. So Chery, which produces Omoda, Jayco, and Jetour, they're the fourth most sold the fourth most vehicles in September, which takes them just below Volkswagen in the third position. So you can see there is a bit of excitement and sentiment loading under the hood. Taking this across to fiscal process. So you've got the year of our story, Lightning McQueen, looking there at the golden trophy, the Piston Cup. We'll get to the Piston Cup later, but the point here is we've seen surging terms of trade that supports the rand and high metal prices, high precious metal prices, gold plats, and that's driven gross tax revenue collection to the extent that it's outpacing Treasury's full year forecasts. The two sources of revenue outperformance have been company tax, corporate tax, in other words, and VAT, and that's good. So this the surging ratio of export prices versus import prices has really shown some positive momentum. So the fund, how this plays back into our positioning, we've been able to capture this with some long end exposure to the back end. In other words, 15-year segment of the fixed rate bond market. But getting back to the issues at hand between the Ministry of Finance and the South African Reserve Bank in terms of the lower inflation target of 3%, we can see the different approaches of politicians and members of the Monetary Policy Committee. The Treasury and Ministry of Finance it's all about the short term and timing the market. In other words, very medium term view in terms of debt GDP, but South African Reserve Bank takes a longer term view. In other words, it's time in the market and it's a disproportionate impact that the inflation has on the poor. There's a natural split in this narrative and a tug of war. But for the SARB, in order for it to be effective in executing its mandate of reaching the lower inflation target, anecdotally, it has to do so by timing the market. So it only has a short period of time where it can actually be effective in implementing that. And one of the Monetary Policy Committee members have told us at a recent conference, the SARB can only successfully implement this when the economy can do the work for you. So it supports the self-help narrative brewing under the hood of the South African economy. But, and again, timing is of the essence. We've seen great progress on this. Hopefully we can see something come out of the medium-term budget speech today. Our view is it'll rather be sooner rather than later for Treasury to announce this. But the impact of this truth is highlighted on the left. Inflation and growth, from an inflation and growth perspective, if we look at the green line on the right-hand side, in a coordinated policy response, lower inflation will be supported by positive momentum and a good growth trajectory. Unfortunately, the SCAR story is not all about the race and how quickly you can get there. We don't expect the SARB to cut rates in November. And the reason for that is, as you can see here on the right-hand side, the blue line versus the red line. Unfortunately, it will take longer for this SARB to anchor inflation expectations at 3% instead of its midpoint. And if you cut at these levels, you could likely undermine the credibility of the SARB in wanting to move to this lower inflation target. We've had conversations with Bureau of Economic Research. I see Investec has brought out an article on this yesterday that they're seeing a 25 bips cut, but Bureau of Economic Research also don't expect a cut now, but all their cuts are priced in for next year. But this underlines the tug of war between the growth give up of the Ministry of Finance and the SARB. So this could play out in that tug of war scenario. Then just to the last section, how do we do what we say on the box? So Gideon and Luigi, they're the small little pit stop guys and play an instrumental part in the story. They are obsessed with Ferrari culture and ethos. So in this section, we'll illustrate how we employ a similar ethos of excellence and show you how this has helped our clients or prospective clients in terms of the performance outcome. So this is one of the most important slides in this deck because it tracks the quarterly returns of the past 3 years. And managing fixed rate bonds, it's not a smooth ride, and there's considerable short-term capital variability. But by utilizing a combination of credit to smooth returns and fixed rate bonds to provide capital growth, we've been able to ensure that it's been a steady ride over time. So you can see the black dots indicates total return. The gold bar is your coupon or your running yield, which has been between 8 and 9% annually over the last couple of years, consistently over the last couple of years. And then the green bar is your capital contribution over time. In other words, the fixed rate bond contribution. This is a quick snapshot of performance overview. So STEFI, South African inflation, and then our fund's performance. But then more importantly, we've been able to, you would see the Piston Cup trophy there, consistent top quartile performance over a 1, 3, and 5-year period. And then on a calendar year performance since inception, the fund has done really well. So since inception, the annualized return about 8.84%. And that's it, Eugene. Thanks a lot for having us. We've seen good flows since we've previously been on this platform. And thanks for all your time and effort in engaging with all these managers.
Yeah, Chris, thank you very much for that interesting analogy that you've used with cars looking under the bonnet. Maybe we should start a new industry award standard for the Piston Cup, but anyway, let's move on from that. Yeah, Chris, just quickly, and I think top of mind, you did allude to some of those points, the medium-term policy statement. And you also mentioned, we've had favorable terms of trade, strong tax collections. But I mean, what do you expect from a medium-term policy statement today? Do we need to see a lot of key reforms with regards to spending and possibly identifying entities or SOEs that are not performing well, cutting spending there? Because I mean, surely this party can't go on. We in the green now, but where to from here?
Interesting question, Eugene, and it's important to actually address that. I think we have taken the first few baby steps in terms of SOE disintermediation, almost where public-private partnerships have been encouraged, and that it's a very interesting dynamic because we've come from this no, don't touch these SOEs to actually help them. The way to contextualize this in the South African context is SOEs have been they've taken away from the fiscus continuously with these public-private partnerships. The ultimately the goal is to have these entities stand on their own 2 feet, and instead of being a detractor of the fiscus, in other words, sucking out money out of our taxes, is actually trying to get to these entities to a point where they can contribute. And I think in conversations with the guy running Operation Bulendela, that's ultimately what they're trying to do, is actually get, and Treasury themselves have reiterated this in saying, like, we don't want Transnet to come to us to beg for more money. We actually want Transnet to stand on its own 2 feet, and that's where we would like to see these reforms going in, more in terms of supporting and letting the continuing on this disintermediation path and getting rid of the red tape so that these state-owned entities can actually start to contribute to the fiscus instead of detracting from the fiscus.
And maybe seeing a lot more privatization deals coming through, but let's see, time will tell. Just with regards to positioning of your fund, a slower cutting cycle is perhaps positive for investors because your reinvestment rate stays a little bit higher for longer. And I mean, we've discussed this to death. Investors in fixed income portfolios and multi-asset fixed income did extremely well at very subdued levels of volatility the past 2 years. But where does that put you with regards to duration in an income portfolio? If you expect less rate cuts or slower pace, um, do you maintain a higher duration, or is it a case that you are more situated in credit and floating rate notes?
It's a good question, Eugene. So from a duration perspective, our fund is a risk budget of around 2 on duration, and we've been probably a bit overweight between since Liberation Day up until, you can almost say, the end of August, beginning of September, and we've taken a bit of duration off the table since then. Bonds have have run really hard, both the belly bonds and the back end. If you weren't in the back end in October, you would have gotten burnt a little. We were a little behind in October because weren't like balls to the wall on the back end, but the back end also brings its own challenges in terms of duration. So we've taken a bit of duration off the table, not much, but we've seen a good run, and because we don't expect a cut immediately, we're conservatively positioned. But on the credit side, if your rates drop, on the credit side, that contribution diminishes a little, but we use a large proportion of govies, and that running yield stays the same. And those fixed rate bonds keep clipping at those rates. It's the capital component then that should see us. So the current running yields are around 9%. Duration of to another 50 bips gets you up and down by 1. Still better than
Yeah.
better than 3-month JIBAR.
ILBs are sneaking into conversations very often. Can that be an instrument that can maybe boost returns for clients over the next 12 months?
A good question, Eugene. We use those more for from a volatility perspective. So they're less volatile than the fixed rate counterparts. So so the ILBs gives you more upside when realized inflation is higher than expected inflation. So in a downward trending environment, we don't expect those to provide you with additional upside, but it's got very good qualities in terms of the helmet, in terms of providing a margin of safety versus fixed rate bonds. So we do have a proportion of those, but we've got front end ILBs because they're more sensitive to unexpected changes in inflation.
Kagiso, I did not forget about you, but last question for Jurgens before we move on to emerging markets. Jurgens, is a very good question from Sean, one of our audience members, and to the point, your fund is in a crowded space. Investors are spoiled for choice. What differentiates you or ID Capital and your fund management team, and how do you generate alpha? Why pick you?
So we're a small boutique asset manager, Eugene, and that sets us apart. So Liberation Day is actually is a very good example of that. So during Liberation Day, we showed you that graph of downside protection, and during periods of stress, we were able to get trade out and actually buy into ILBs. In other words, at a very quick rate. So it allows us to be nimble, being a smaller player in a crowded market. And we've shown that we can produce consistent performance and return over a 5-year period since inception of this fund. And I think that talks to your strength as a small, nimble player, as a boutique asset manager. I mean, and ultimately that should set you apart from other players in this crowded space, because you've got the numbers to show for it, you've got the process and the philosophy to back that up.
Exactly that. I mean, it is all in the numbers, as you clearly illustrated, and that nimble mindset, being able to move around in a well-qualified team. That's always a good answer. Jurgens, I'm going to keep my eye out for more questions for you, but I want to move on to Kagiso, All Weather Capital. Kagiso, your presentation, very interesting in emerging markets. And I mean, there's been so much debate with portfolio managers, intermediaries constructing portfolios for clients on allocating to emerging markets, and especially in the current environment, we know that a lot of the US companies are pricey. Some economists are a little bit worried about the US. Emerging markets, as you clearly mentioned as well, very well priced relative to developed markets. But we've allocated to emerging markets before, and emerging markets tend to be extremely volatile. This time around, with the dollar under pressure, do you think there's a lot more scope in emerging markets for investors?
Sure. Thanks, Eugene. That's a very good question. So I think for us, what we want to get across to the market is that what most people miss is that emerging markets actually participate at a 65% of the global economic activity. That's on a GDP PPP basis. However, if you look at the global markets, we only have around probably 10% of the pie. So besides obviously the tailwinds like the weaker dollar, we think the market should really catch up in order to match economic activity, as well as like upweighting EM's weight in the global stock market. So I think for us, really, it's just that structural misalignment, right, between EM's participation in global economy and its weight in the global stock markets. So we think as time goes by, and as we see these headwinds that are coming out of the US, we think we're going to see a bit more flow and allocation into EM, just to see that re-rating.
When I look at South African investment portfolios, obviously a big chunk of their assets are invested in South Africa. And some will argue, but that's already emerging markets. So why then should I allocate to my global component, whatever that global component is, whether it's 20% or 100% of portfolio? Why do I allocate more to emerging markets if I still have a lot of emerging market exposure in SA?
Yeah, sure. So if you look at our benchmark, right, South Africa is only just over 3% of the EM benchmark. So it's quite a very small player in the whole emerging market space. And I think also your investors need to think about the industries and the sectors that they're being exposed to, right? Obviously, SA, we play the commodity sector through your PGMs, and that has done well for us. But some sectors, from a South African investor perspective, you're not really exposed to. So those are your high-tech stocks. Those are your EVs. Those are the fintech companies in India. So really, if you want a more diversification, especially in this turbulent environment that we're in, we just think that EM is really the place to be. And also, if you look at really the correlation between SA and EM, that has been breaking over the years. So, yeah.
You spoke a lot about AI, and I mean, some of the companies that you hold as well, like TSMC, has been a big benefactor. Huge capex in the AI sector, especially from the mega caps in the US. There are strong arguments or people questioning if they'll ever be able to monetize this capex spending. And then you've got the odd article saying, but there's another bubble forming. With AI and this massive capex, yes, there's a lot of AI companies, especially what you mentioned now, some examples in emerging markets benefiting for that. But do you see this as a long-term investment strategy, or are we riding momentum on the back of a bubble?
Yeah, sure. So I think for us, I think it's very important for me to mention that our mandate focuses on emerging markets. So in terms of within our universe, we really play on those companies in the back end supply chain, right? So we don't think it's a technological trend, but we think it's a long-term structural play. So we're only in the beginning of AI. We're really in the training phase. I think I was listening to a podcast and one guy make an example, and I just think this would just put it into perspective in terms of where we are in the beginning of AI, in terms of training versus the next step, which is inferencing, right? So I'll use a dog analogy, right? So with AI, you have a dog and you train it. You throw your ball over and over. In the beginning, it really doesn't know what to do or where to go. And as you throw it and you repeat that, then it knows what to do. So it quickly goes and takes the ball. So that's the training part of AI. And that's the stage that we're in now. But as your dog gets more comfortable, you can do a whole lot more things. You can throw your ball to the beach. You can throw 2 balls and you can throw it up in the tree. And that's because your ball is more comfortable and it knows those patterns. And then it starts just doing a bit more tricks. So that's the inferencing part of AI. I think that analogy is very important, that AI it's really at the early stages. We're seeing sovereign build outs. It's being really integrated into everyday work life. And that needs a lot of computing power. These tokens, I think TSMC made the point that the tokens levels are rising at least double each month. So that just talks to the real demand. So we of the view that the capex cycle is definitely going to continue into the future. And this is just the beginning. And sure, I mean, that is a very good point in terms of the capex level, especially in the American space. In our space, the management has been quite disciplined, right? And obviously, as a finance scholar, obviously there are certain red flags when companies start doing like vendor financing, and I invest in you and you invest in me, and then you sell me and then I make revenue. So in this American context, the AI industry is becoming a bit frothy. But I think what investors also turn to overlook is that these capex are not being funded by debt, but by rather higher operating cash levels. So the revenues are not growing obviously at what the capex levels are. But I think the play is that it's short-term pain for a long-term structural benefit. So it's more of like a FOMO of not missing out, because in technology, if you're left behind, it's very difficult to catch up in the future. So it's definitely a long-term structural play for us.
I do feel behind sometimes if I look at the progression and the speed in the AI space. I know the clock is chasing us, but this is a very interesting conversation. And I mean,
Sure.
overall, it is an EM fund, not just an AI fund. But let's unpack your fund a little bit more and just try to understand regional allocation and trying to understand your views on China. EM has done well. China showed good recovery, especially in the Hong Kong shares. There's
Yeah.
been a lot of income there. Do you have specific regional allocations and in China specifically, and are you looking at mainland China as well?
Okay, so currently we're very constructive on China. Our fund has been overweight China, and we're not blindly bullish on China, but we think that they asymmetrically it does look like it's still very attractive. And I think I guess there's three tail points that I will touch on. Number one, we think that as much as the recent outperformance, the valuation still looks very attractive relative to its historical averages. And this is given the high top line growth as well as the EPS growth that we've seen in the current year. We also like those sectors that have strong government support, like your high tech, like your EVs, like your renewable energy. We think those sectors has tailwinds in the form of favorable government policies as China tries to entrench themselves as a global leader in the global supply chain. And also what we've seen is that the household savings has always been an overhang, right, in China. But we've seen that that's gradually moving back into equities. So the cash balances at peaked was almost 2 times the value of equities. But right now, that value has gone down to like around 1.6. And I think also the other biggest overhang for China was obviously the US and China trade relations, right? However, I think we've seen over the course of the past few days, the rhetoric that has been coming out of US and China has been incrementally positive. I think the US is moving from containing China to cooperating with China. Because I think on a global scale, unfortunately for the US, they really highlighted how China is entrenched into the global supply chains. So because of those tailwinds and that positive backdrop, we're very constructive and still overweight China.
I think we'll see some Chinese LED light bulbs in the new dance hall of the
Oh my
White House,
God.
but let's
Yeah.
see. Well, exactly that. I know we are pretty much out of time. I want to finish off with one question from the audience, and it speaks to your benchmark and the portfolio holdings. Is the broad emerging markets benchmark appropriate considering your fund's concentration? And how do you manage the relative sector weightings in striving for differentiated returns? And how do you correlate to the benchmark?
Um,
A long question, 3 questions there.
yeah, it's a three-part question, but can you just probably extrapolate a bit more in terms of concentration?
Well, you mentioned you've got 55 to 75 stocks, and I think that's
Yeah.
where that comes from.
Mm-hmm.
The benchmark, obviously, a lot more stocks, so you can argue that your portfolio is very concentrated relative to the benchmark. But is the benchmark appropriate, and how do you correlate to the emerging markets benchmark?
Is I'm having a very difficult time understanding that question. Is our EM benchmark appropriate for the fund?
Let me maybe try to rephrase it differently. And again,
Yeah,
it's a
yeah,
question coming in from
sure.
the audience. I can't. Maybe what they're trying to get to is, are you a benchmark hugger, and how does your fund stack up relative to the benchmark?
Okay, sure. So in terms of our investment style, I think
Yeah.
that's what we mean. We are a style agnostic investor. So we think that in EM, in the space that we're in, we have more of a pragmatic investment process. So we understand that some companies deserve to trade at a premium, and some companies do deserve to trade at a discount. So we're not going to invest in like a high tech companies because we're a growth company, or we're not going to invest in a tech company because it's optically expensive. However, it is a growth compounder. So we think being style agnostic really gives us the flexibility to go where the opportunities are. And this is whether it's value, growth, and quality or cyclical. So as long as we see the risk reward makes sense, then we invest. So I think if they're asking about our style, it's more of a style agnostic portfolio. But we definitely not concentrated in certain sectors. We do have a universe of around 50,000 stocks, but then we apply strict liquidity criteria, and then it takes it down to around 2,800 stocks. And then we have like internal models and matrices that look for like strong balance sheets, ROE, sustainable growth rates, etc. And then that would then take that universe from like 2,800 stocks to around 300, 800 stocks. And that's what we call our quality universe. And then from there onwards, we do the work. And then that's when we end up with a portfolio of around 55 to 75 stocks that are style agnostic. I wouldn't say it's concentrated.
I hear what you're saying, and I think maybe the concentration risk, I think, threw off the question. I think what would be very interesting to see going forward is maybe a slide looking at emerging markets benchmark, the sector allocation, regional allocation, and then showing your fund sector holdings relative to the benchmark and trying to almost assess how that differs. But I'm going to park it there. Unfortunately, we're very much out of time. There's so much more to discuss and to unpack. Kagiso, thank you so much for your time this morning. It's been very, very insightful indeed. To our audience, you know how it works. Open door policy. If you want further discussions, please get hold of us. We will put you in touch with All Weather Capital. And Jurgens, ID Capital, I know you're at the background. We can't see you, but thank you so much for joining us this morning as well. Very good indeed. The numbers are in your fund. that question about how do you differentiate yourself. I think you've answered that very well. Thank you so much for your time this morning as well. I really appreciate it. Thank you.
Thanks, Eugene.
Yeah. Thanks, Eugene.
Good stuff. Quick reminder to our audience, next week, Wednesday, 19 November, we've got Marzi Capital. And don't forget, 20 November, we've got another hedge fund webinar where we continue unpacking hedge fund strategies and what it means for your clients. Looking forward and seeing you next week, Wednesday and Thursday. Have a super week further, and we'll chat soon. Thank you.